Okay, so next we've got financial history validation.
Yeah, and so the next two are really somewhat synonymous, but they're very different, right? And we don't. Again, we're living in the world of entrepreneurs, so you hear different terminology like tax-based financial statements, or cash-based financial statements, or accrual-based, or GAAP financial statements. All those kinds of terminology are thrown around in terms of financial statements. For the most part, businesses, until they get to a certain size, entrepreneurial businesses in particular, early stage businesses, or businesses, in particularly the first couple of years of life, normally, those businesses tend to operate on what I consider to be more of a tax return basis. But there is, separated financial statements that are generated internally. Frequently, those are really management reports intended for management, purview, used and shared in that manner. But when you put something, you call it a financial history as a general rule, but you're really saying, the expectation, if I'm an accountant on the outside looking in, or I'm a banker, or I'm an investor, the expectation is that when you give somebody a financial statement, you give them a balance sheet associated with that, or a cash flow statement, you give many of those kinds of things, there's an assumption that you've followed certain levels of rules. And that assumption may not always be correct. In other words, they may come out of, you find that a lot with the people who are in the venture capital place. They're used to dealing with companies who have audited financial statements all the time, who are following a certain, standards associated with audited financials. And so when they go into the entrepreneurial world, they're expecting similar kinds of rules to be being followed with financial statements. That's not always the case with entrepreneurs. Entrepreneurs are a little bit more casual. Their financial statements sometimes don't have the same level of validation associated with them. Shortcuts that are taken there, which are not necessarily intended to misrepresent, but they sometimes do misrepresent because the person on the outside is thinking they're looking at something in Spanish and they're reading German. So it's important that the financial history is validated from the point of view of understanding the rules around how it was sourced, how it was presented, and so forth, and not just accepted at face value. A balance sheet is not a balance sheet in every time, and wasn't put together the same way. An income statement, I think I've said that to you before, exists between two balance sheets. If you don't have one of the balance sheets, you're violating a core rule about what an income statement really is. So we have to kind of validate what we're communicating in terms of financial statements. And when I review financial statements, that's the first thing I do is I say, am I interpreting them correctly? Can I validate what they're telling me? Is there a misunderstanding about the premises around the financial statement? So that's on the financial history validation, that deals to those issues. The tax returns similarly, but they have a different audience. Tax returns are for the audience of the IRS, for reporting your taxes and so forth. You don't necessarily have to follow the same rules of a financial statement. They have, it's a hybrid form of rule, it's tax law. And sometimes, you can take two companies, same income, same circumstances, and they may report their taxes differently just simply because of the way they chose treatment. So same thing there, you've really got to validate what the tax return is telling you, what the assumptions behind it are, what the sources of it are. Frequently the sources are management information that's been provided to a tax return preparer. He accepts it at face value and goes no further to validate that. He's covered his butt in that regard as far as that's concerned. But in terms of, does it have potential for misstatements or things that are misunderstood? Yeah. So that goes back. They're separated validations, both from a financial history validation and a tax return validation. Important parts of the agreement. And we've got to find a roadmap between the financial history and the tax return. We've got to understand how you got from one to the other, and so we can clarify where those adjustments were made, why they were made, and so forth. That's part of the process.
Absolutely critical for those under $5 million deals that are dependent on SBA financing. The lenders are using the tax returns as their underwriting documents. And, I see so many people email me, why isn't this one SBA? Why isn't this one an SBA? And it's often because either the growth of the business has been so staggering that the tax return from the prior year doesn't lend itself well to being able to support the current year's, trajectory and next year's trajectory. So just from a financial standpoint, the SBA loan can only finance a certain portion of it. But more often than not, it's because the discrepancy, what I've seen anyways, just in my own humble experience, the discrepancy between a balance sheet and a P&L, the income statement that the entrepreneur is outputting from QuickBooks is often quite different from what is on the tax return. And, most entrepreneurs, tend to try to be aggressive with their tax and their savings. And that sometimes comes back to haunt them because their tax return doesn't show the same level of net income as their P&L does.
And it can be very, costly to them, right? I mean, and I say make that, explanation all the time. And that is sometimes you save $10,000 in taxes and cost yourself $300,000 in business value as a result of those kind of activities. So you do have to understand what you're doing, why you're doing what you're doing, and understanding the trade-off in that regard. And if you're in the position of strategizing to sell a business, in the next 1 to 3 years, then paying attention to your tax returns, sometimes your historical tax returns, and making sure that you've addressed those is a very valuable exercise to go through, because to your point, that's what's looked at. And when an SBA lender is looking at it, if I go down again, just as a quick down to it, one of the things I talk about is a healthy core business test. They don't call it that way, but what they're really saying, is it's conservative. They're historically focused, right? Where's the business been? They're less concerned or less, bought into the idea of where's the business going. The buyer is buying where the business is going, but the SBA and most lenders, are lending against where it's been. And there's that disconnect sometimes that's hard to bridge unless you've got a strategy to bridge that. So you've got to understand sort of the metrics around which an SBA loan is made, an SBA valuation is made. That's a different market or a different target than someone who is more clearly aligned with, I want to buy this business and I want to reach a very aggressive growth multiple in 5 years. They're aggressive to the point, so they're willing to value the business a little bit differently. So, and the audience, dictates to a large degree is what you need to emphasize in those kind of valuation arguments, so to speak.
Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller?